What's going on, everyone? Welcome back to Sin City Crypto. I am David. I'm joined with Robin, and today the hottest topic of the day is inflation. The CPI numbers came out, and we are well above the forecasted price that we were expecting. And just to talk about it, first thing I'd like to do is I found a really cool video from Investopedia, one of our favorite resources to use. And it's just a minute-and-a-half video breaking down what CPI exactly is visually. So without further ado, let's go ahead and play this for you guys, and then we'll talk about it coming out.
The Consumer Price Index, or CPI, is considered the benchmark inflation guide for the U.S. economy. It uses a basket of goods approach that aims to compare a consistent base of products from year to year, focusing on products that are bought and used by consumers daily. The price of your milk, eggs, toothpaste, and haircut are all captured in the CPI. The CPI is calculated by taking price changes for each item in the preset basket of goods and averaging them, with the goods being weighted according to their importance. The index uses a base year for comparability of its calculations, so changes will often be provided on a percentage basis to reflect only changes to prior index levels. There are two CPI figures: the CPI for urban wage earners and clerical workers, the CPI-W, and the CPI for all urban consumers, the CPI-U. The most watched metric is the CPI-U, which is often presented with a seasonal adjustment, as consumer patterns vary depending on the time of year. The CPI is a detailed release with breakouts for most major consumer groups and geographical regions. The CPI is also used to identify periods of inflation or deflation. Large rises in CPI during a short stretch typically signal periods of inflation, and large drops in CPI during a short period usually mark periods of deflation. As well, the CPI is used to make changes to cash flow mechanisms such as pensions, Medicare, and cost of living adjustments. This versatility means the CPI affects nearly every market and person in America.
All right. So there's just a brief overview of what CPI is. Robin, anything stand out to you out there that I know it was a pretty straightforward video, but there's also, if you want to talk about this, something I want to show. Well, actually, before you answer, Robin, I want to show this. So if you're curious as to what exactly, how it's calculated, this is a pie chart. You have food and beverage in green, housing, apparel, transportation, medical care, recreation, education, and other goods and services. What I want to highlight is the blue. That is housing that makes up over 42% of what is weighted when it comes to CPI. Coming in at number 2 is going to be transportation. This includes energy prices. Now, you got to remember the difference between CPI and PCE. PCE takes away the two most volatile, being the transportation, in this case energy, and also housing. So we know transportation and fuel were down, but housing was up, which brought the CPI numbers up to 8.3% for the month of August, year over year. I know a lot of forecasters were saying we were going to come in closer to 8.1. Are you surprised, Robin, like I was, to see this number come in higher than forecasted?
You know, I was, if you're looking at the national average when it comes to the price of gas, which has been one of the biggest factors on this elevated CPI number, or one of the biggest contributors when it comes to inflation, it was the price of gas. Not only is it a cost on everyday person, me and you, with the gas tank, the price to fill up the gas tank, but it's also the cost of transportation of goods moving around from distribution houses from warehouses to consumer. And so that surprised me, yes. But at the same time, let's zoom out and look what's going on. For one, we were over 9% inflation 2 months ago, down to 8.5 last month, now down to 8.3. And so we are in a trend downward. So the interest rate hikes that we've seen from the Fed time and time again, we've had 275 basis point hikes as of recently in succession. Now that's starting to impact inflation. or at least bring it down. So that's what I'm kind of taking away, is that we are trending downward, just not quite as fast as people were hoping. And we were only 0.2% off of the
Forecast.
So it's
So then-
not anything too drastic.
So then what are your thoughts on, and I'll share this, so just so you can see, what are your thoughts on this chart right here? The Dow Jones down over 4%, down 1,300 points. We have not seen this big of a decline for several months. And if you take the pandemic crash out of it, which was a black swan event, you can go all the way back to 2008, 2009. We haven't seen a drawdown of this size. So if it was only 0.2 of a percentage point off of the forecast, what are your thoughts on why the markets reacted so aggressively to the numbers coming out?
Well, here's the thing. We have a couple things going on. One, you have the Fed's expectations of rate hikes. And with the Fed's expectation of rate hikes, there's going to be no easing. And so people's idea going into today's number, before today's number, was this thought that, hey, we're going to come in under inflation. And because we come in under their inflation numbers or target, then the Fed can pivot, not raise rates quite as high, and they can. It's not going to be this big 75 basis point rate hike, and that all just got thrown out the window, because not only was the inflation numbers not as good as we were looking for, but it came in worse, and so now it gives, with a strong employment market.
Yeah.
Employment market's strong. And so now they have all the ammunition, and inflation is not coming down as fast as they wanted it to. And so you have a situation where, hey, the Fed is going to keep doing what they're doing, and there's no reason at this point in time that they're going to slow down, right?
Yeah.
And that sell wasn't because of the number. The sell was because of the expectation that until December, we're going to see a very hawkish, very aggressive Fed when it comes to interest rates, and they're going to freaking push us into a recession, whether you want it or not, whether you believe it's here or not. If you think it's here, we're going deeper. If you don't think it's here, it's coming.
Now, I want to pivot to, I want to show some more numbers here, okay? So this is the rent inflation in the U.S. You can see it had the biggest jump it's had since arguably September to October of 2021. We saw an increase of from 5.7% in August to over close to 6.25%. If we take a look at the core inflation rate, we're sitting at 6.3%, up 0.4% month over month from July. Also one of the largest increases. Now, here's what's important about this core inflation rate. This is what the Federal Reserve uses to figure out what they're going to do with their monetary policy. They don't look at CPI number. They don't look at PCI number. They look at this, the PCE, the personal consumer expenditures, the core inflation rate. Now, I spoke about this on our live show today. I believe now, with these core inflation numbers in at almost 0.5% higher month over month, that 100 basis point rate hike is on the table. Robin, am I crazy to think that? Is 100 basis points even in the realm of possibilities?
No, definitely. Well, I don't want to say definite. The CME has projected that there's about a 14 to 15% chance of a 100 basis point rate hike, which was pretty much not even on the table before today. So there are people that are taking it into account and they think it's a realistic possibility. But with that said, we did see all 40-year highs on the inflation when it was over 9%. The Fed, if they were going to do a full 1% interest rate hike, it probably would have been then instead of now. So inflation is coming down, probably not quite as fast as some people would like, maybe even the Fed. But I don't think they're going to change their stance on this on 75 basis points. They still have this soft landing thing on the table where they're trying not to crash the market by getting inflation under control. I'm glad you brought up the rent going up. Let's not forget that we were at this eviction moratorium for a long period of time. That has exhausted a couple months ago, which is probably why we're seeing it on the data right now. Think about it. People that had not paid rent, that were taking advantage of the programs in place that would avoid evictions. The process is now going through where tenants are able to rent out these properties that they haven't been able to rent since 2019. And so if you went through this whole process and now you're listing your home again, you're probably going to list it for a higher price than in 2019. Fair to say that the market value of rent has gone significantly up in that time period. So maybe that's the cause for it.
Now let's pivot to how the cryptocurrency markets have reacted. And so here's a list of liquidations over the last 24 hours. The volume is the amount is at volume 341 million, up 52% over the last 24 hours. You can see the total liquidations for all cryptocurrencies over the last 24 hours is north of $340 million, with a majority of that coming in the last 12 hours. If we scroll down here, you can see obviously Bitcoin has been liquidated the most, followed by ETH, Solana, and then Ethereum Classic, coming in over $1 million in liquidations. And you can see here, majority have been longs. Over 75% of the liquidations have been long. We take a peek at the order books. Where can we see the bleeding stop? We see a break point here right at $20,490. That is when the balance of buy to sell flips to the buyer's side. So I would expect, if we do go down, to see low, even right at 20,000 seems to be a good support level as far as the order books are concerned. We know when the traditional markets tank, when bad news comes out, Bitcoin and cryptocurrency, they react much harder and faster than the traditional markets do. On top of that, you have the Dixie, the dollar index against other currencies, continuing to rise, possibly breaching its 21-year high it made just a few short days ago, which obviously we know with historical price action as well. When the Dixie continues to rise, risk on assets bleed, including Bitcoin.
I will say that, it being, today's filming September 13th, the NASDAQ is down over 5%. The S&P 500 is down almost 4.5%. This is absolutely tremendous. Just to put that in perspective, you don't see these pullbacks that often. Very rarely, especially in the S&P 500 over 4%. And the markets have moved in tandem when it comes to Bitcoin and the overall legacy finance. And so if you're watching this today, September 13th, I would be very wary of what's to come over the week, barring a last minute bounce back in the stock market today, or maybe even a rally throughout the end of the week. I would expect the crypto markets to pull back significantly. I think the 20K level will probably be broken. And I'd be very, very, very careful on entering and exiting the market right now. Really think about your positions.
Yes, proceed with caution, and make sure to tune in Monday through Friday at 10:30 a.m. Las Vegas Pacific time for our daily live show. We will do all the research for you and keep you in the know. Until then, thanks for tuning in, you guys. We'll see you next time. Take care. Peace.